name is Michael Guyan, publisher of the Lead Lag Report. Joining me for the hour is a friend at this point, a colleague in the industry, and a overall great guy, Mr. Mark Yusko. So we'll be doing a lot of talking about markets today and going in a lot of different directions. Mark, before we get too deep into anything, tell the audience who you are and what you do.
All right. Well, Michael, thanks for having me back on the show and excited to do this on a Friday early evening. So Mark Yusko, I'm the CEO and CIO of Morgan Creek Capital Management and the managing partner of Morgan Creek Digital, which is our operating subsidiary that focuses on all things digital. So I, by way of background, used to work in the endowment world. My alma mater at Notre Dame, then University of North Carolina, Chapel Hill. Started Morgan Creek back in 2004 to bring the endowment model of investing to other investors. And our mantra is alternative thinking about investments. So we don't believe in alternative investments. We believe that you should think about different strategies for getting exposure to traditional assets like private and venture and hedge funds, et cetera. The only other thing you need to know about me is I love to fly fish, and that's about it.
I never quite understood what fly fishing was. I mean, I'm a city boy, but I feel like that's maybe a conversation for another day.
Absolutely.
Right, so there's a word I want to focus on for a moment, which is destruction, because there has been, I think, far more wealth destruction this year than the media puts out, and more than probably most people realize. And what I'm really talking about there is the bond market. Now, you and I have been in business for a while. People tend to think that as long as they're getting their monthly coupon, their monthly income from their bond investments, that it's fine. Who cares about the underlying price, right? It's money good as long as they keep on. And that was the case with a large number of investors in 2008. But there has been a lot of real pain in the market value of bond funds, of individual bonds. I want to hear your thoughts on if you think equity investors are underestimating how much loss has occurred in the asset of fixed income when all we hear about is yields rising, but we're not really hearing about total return.
Michael, I think it's a really important point. And destruction is the watchword for today. In fact, normally when we do the get together in the evenings like this, we have the drinking game, and that should be our word. We're saying destruction a lot tonight, and everyone could get an early start on the weekend. But the bond market decimation is the worst since, wait for it, 1780. Just let that sink in for a second. Okay, they keep track of this. The loss of, or the increase in rates and the destruction of total return in bonds is the worst since 1780. So that's a long time. And it's probably not over. Well, we're going to talk about that. It's possible that it's over and we're going to hit an inflection point like we did in 2001 and things will stabilize here a little bit. But there's also a path that says the Fed in particular and other central banks around the world have actually lost control, and that the liquidations have begun. And someone actually tweeted earlier today at dark 30, I mean, literally 5:30 in the morning, 10 days ago, with Sully on CNBC. And we were talking about it, that, the garden variety correction was starting to look like a liquidation. And you see it in crypto yesterday, right? 10%, 15% drops in a couple hours. That's not normal action. That's a liquidation. You've seen it in long bonds. Long bonds are down 25%, 24% year to date. So again, if you were making 2.5% on your long bond investments for the last few years, you've lost 10 years of yield in 4 months. That is massive destruction. So I don't know, where else do you want to go with that?
Well, okay. So, and this is what drives me crazy about the constant comparisons to the 70s, because even if you look at the drawdown in treasuries, for example, in the 70s and compared it to the drawdown in equities, you wouldn't see what's taking place this year, right? In other words, what's happened in terms of the sequence, not just in terms of the magnitude, but also in terms of the correlation to equities, is like a black swan of all black swans. We've never seen this type of a period, even in the 70s in history. Now, you kind of alluded to this idea of, well, maybe it's not over, maybe it is over. Let's talk through that for a bit, because one of the things which is interesting about thinking about the bond market is that the reality is bonds have had negative real return for a long time. Right? They've been losing money. It's been money illusion. Sure, you make money in terms of that dividend if you're in a bond ETF or you're doing an individual bond, you get the coupon. But we know it hasn't kept up with inflation. So the question is this what we've seen, especially the last 4 or 5 weeks here, capitulation after a prolonged bear market in terms of real returns for bonds, or is it an ominous sign of more to come? Because the other part of this destruction, which is unusual, is that you haven't seen what you normally see with destruction, which is widening credit spreads in a massive way.
Yeah. And again, a really important point. So, look, we've been in financial repression for the better part of 13 years, since 2009. And that is an intentional series of actions by global central bankers to force capital out of the traditional short duration and low risk assets into riskier assets. And that financial repression has led to this long-term downtrend in interest rates. So, short-term rates literally went to zero or negative if you're in Japan or Europe. And so, think about that. You actually literally had to pay the bank to hold your money. Crazy. Capitalism breaks down at negative interest rates. And on top of that, bonds became certificates of confiscation because, as you said, every day you held a bond, you were having your wealth confiscated in the form of negative reals. And so yet there was still this idea that the 60-40 was where you should be, because in the event that there was a correction in equities, because equities were blowing the biggest bubble of all time over this period, because as interest rates fell, people did the crazy calculation of, well, future earnings and future cash flows are worth more if I have a lower discount rate. Well, there's a point at which that Fed, as it's called, breaks down. And I actually think that is 2% rates. Because if you take it to its illogical extreme, Michael, if interest rates are zero, are stocks worth infinity? Right? Any number divided by zero is infinity. So this idea that you should pay 10 times revenues, 20 times revenues, 50 times revenues, 120 times revenues for Zoom at the peak, a year ago. And in the past year, Zoom stock, I think, is down, last I checked, like 90%, 90. It's a good company, good product, but the stock was in Stupidville. And this is a long answer to your question, but that financial repression pushed people out on the risk spectrum. It pushed them into imbalanced portfolios that had, I call it, sins of omission as opposed to sins of commission. People were ignoring the real risks that they were subjecting themselves to. And part of it wasn't their fault. Part of it was we've all been forced, because of the way 401k plans work and 403b plans work, to have these horrible portfolios with very little diversification, very few options. And so again, I'll stop there and say, look, it is a interesting time. There's a chart that I love, and everyone's seen it, that either follows you or I or others on Twitter, called Chart of Truth, that Raoul Pal put out. And it basically shows this downtrend in rates. And every time we got to the top end of the downtrend, which was right around 2.95, 3% in the most recent period, we'd immediately head right back down, because the demographic pressures of the Western world are so extreme. Too many old people. Old people don't spend a lot of money. They're not very productive, perfectly nice people, but not productive the way we measure productivity. Working age population growth is shrinking. Debt loads are monstrous. There's no way countries can refinance their debt at higher rates. So that's why I say it's possible that we have hit that point, that point of truth, that moment of truth. And barring just a total loss of control and a total liquidation of the Chinese holdings and the Russian holdings and the Belgian holdings, which are really Saudi and African monies. Barring that, I don't see how we get out of this place without a reversion back to, without a Powell pivot, right? Which is, everyone's saying, we're going to have 10 interest rate hikes. I think we're done. I think we've seen zero additional rate hikes at this point.
There's a lot to talk about there. So you said correctly, so capitalism breaks down at negative rates, but it also breaks down with spiking rates, which alludes to the point you just made, which is that the more rates keep doing this as far as government debt goes, well, now it's interesting double whammy that's happening, where interest expense for government spending goes up, spending is continuously going up, and then on top of that, there are probably less tax revenues because of the capital gains tax now on a smaller base because of the sell-off in all assets.
Yep.
Right. So that then I think it's also interesting at this point that people don't. It's like what's down is up and what's up is down. If you were to look, for example, at the a conservative allocation versus moderate or aggressive, any of these ETFs or funds, which are more heavily weighted towards AAA and Treasury, ex dividend, they are actually below their COVID crash levels, whereas triple B and junk debt. So a lot of things are really very screwy in this environment. But let's go on this point about the Fed hiking rates, right? Because I've joked about this before. Fed hiked rates 25 basis points prior to the most recent move here, and think about how much market cap has been lost just from that single move.
Yeah,
I think people seem to be underestimating how much tightening has occurred without the Fed really doing much.
100%, and that's the whole point, right? Is the thing about the Fed funds rate that I just find comical is, do you borrow at the Fed funds rate? Because I don't. I mean, I don't get that benefit, right? I would love to borrow it at 25 or 50 or 75 basis points and buy risk-free treasuries at 3% and lever that trade up 11 or 12 times. Well, that's what JP Morgan does every day. They had 0 negative trading days last year again. And that's just, again, steal wealth from the masses and give it to the banks. So I don't know anybody who gets to borrow at Fed funds. And so the idea that the Fed funds rate is a really good indicator of financial conditions, loose or tight, is silly. If you look at financial conditions in the last 4 months, we had the greatest tightening of financial conditions in history, both rate of change and amount. And that's going to show up in a whole bunch of places. And if you look at any of the leading economic indicators, they are tanking. And I'm actually quite concerned, to be honest, that there's only one precedent for what we're about to go through, and it ain't the 70s. It has nothing to do with the 70s. It has everything to do with 1937. We had 0 interest rates. We had QE for the first time. That's when it was invented, post the crash and the depression and the recession. So we had the Great Recession following the crash. And in 1937, the Fed tried to raise rates to, get us out of this malaise, and they turned a garden variety recession into the Great Depression. And, the next 4 or 5 years were really, really horrible. And people just forget history. And so we're at this funky place where, again, we had QE, we had interest rates really low, and we just tightened financial conditions into weakness. And then on top of it, I don't know if you've seen the picture, I'm sure you have, of all the ships lined up in Chinese ports that can't get in and fill up. That massive disruption of the supply chain. And I have my own theory about this, why that is happening, and whether you think it's intentional or unintentional, or whether you think they're being crazy about COVID or whatever. It doesn't really matter. The fact is, supply chain disruption is about to get wicked, right? You said, something wicked this way comes for the title of this thing. That is the wickedness. And if anyone thinks we're going to have a robust economic recovery here, I don't know what they're smoking. And, I have a thesis that the best we can hope for, the absolute best we can hope for, is that this is 2001. Right? 2001, first quarter was negative, second quarter was positive, third quarter was negative, 9/11 exacerbated the problem. We had a mild recession, 1% GDP growth for the year, market corrected about 11%, exposed all the frauds like WorldCom and Enron, and 2002 was a bad year in the markets, down 22. That's our best case outcome in my mind. The worst case is we have, the late 1930s, and this really turns into a depression. I don't like to think about it, but it's certainly possible.
I want to tease that out before bringing in some of the audience here, but I think this is interesting. I haven't heard the idea that we could be entering depression, because oftentimes when you hear people say that, it sounds like clickbait, right? It's like, it's hard to imagine. But there is, I think, an argument to be made here that, and I've made this argument really since last year, it seems like the multiplier effect is broken, right? Because all that stimulus didn't result in new highs in speculative areas. It actually resulted in the speculative areas starting to collapse, really, in February, when ARK peaked and also a lot of cryptocurrencies peaked. That seems like it's not that far off. If you agree that the Fed's ability to control where money goes is no longer there, the multiplier effect is broken, and you have this much leverage, then a global margin call would conceivably create a depression-like environment.
Well, think about it. Look at velocity of money. Absolutely collapsing. No demand for loan. I mean, the problem is if you're already in debt, you're not going to take on more, even if it's free. If it's more highly priced than free, you're definitely not going to take it out. And everybody says, "Oh, but velocity is a residual, and it's not really a good indicator." No, it's a really good indicator, and it's been collapsing for a long time. And this whole idea, I don't know, I get kind of crazy when people think the Fed has control of things. It's like inflation. What we're dealing with right now is not inflation in my mind, right? I mean, inflation, demand pull inflation is when you have excess demand, limited supply, or limited supply with normal demand, and prices rise. That's what we had in the 70s. We had supply shock. We had great demographics. We had everybody, all us boomers entering our peak spending years at 45 to 55, and it was 35 to 45, and it was awesome. Now we don't have any of that. Right? We have no excess demand. What we have is currency devaluation. And that currency devaluation is what's causing housing prices to seem like they're rising. I said houses don't grow. They don't get more efficient. They actually wear out. You have to put more money into them to keep them even normal. What goes on is the currency we value them in is being destroyed. And that's why Bitcoin prices rose so much over the past 2 years before they started down, to your point, starting in November. It wasn't so much that Bitcoin got better. One Bitcoin is always one Bitcoin. It's that the currency we value it in got worse. Someone asked me today earlier, I thought this was a great question. What's the best performing currency this year?
I mean, it's the dollar, right?
No, the ruble.
Well, that's true. Okay, you're right. Yes.
And so it's like, what? That's not possible. What the war and again, markets are funny. Markets are hard. Ruble, best performing currency. And before that, it was actually the renminbi. And then the renminbi had this weird weakening, about 4% over the last couple of weeks. But before that, the dollar actually wasn't strong. It was like, oh, Dixie's up. Dixie's up because it's 2/3 euro and 1/3 yen and a couple other little things. And all that means is that the ECB and the Bank of Japan, Lagarde, who's the queen of money printing, and crazy Kuroda-san, who is literally crazy, we're just printing more money than we were. And so we went down the least. So I don't know. I think we're in a really strange place. And I actually don't know how we get out of it from an economic recovery standpoint. And I see a bunch of people on here a better answer for that than I do, but I just don't see how we get out.
I will say if one Bitcoin equals one Bitcoin, I just want to say for the record that one lentil also equals one lentil. Just for those that are following me, you will get that joke.
Few, my friend, few. No, but I'm gonna take the other side. Look, the Fed has been actually really clear, but no one wants to believe them, and everyone wants to make fun of them. They've said all along that this is transitory, and it is, right? 75-ish% of the increase in CPI over the last 12 months is from two things: oil prices doubling, which is not going to happen again, and used car prices going up a huge amount, which again, not going to happen again. So those two things are absolutely transitory and will fade again. And when people try to call this the Putin inflation, it has nothing to do with Putin. Absolutely nothing to do with Putin. And now food prices certainly could enter in there, but those don't get counted in CPI as ex-food and energy. But that's another little glitch to the thing that the lockdowns subsequent or lockdowns in China to me have a lot more to do with potential for further inflation and further supply chain disruption, where I would think there'd be some true inflationary pressures. But I think the Fed's been very clear, and I don't believe they think that they can actually lower the inflation number by raising rates. I think they're raising rates to put bullets back in the gun so they can stimulate in a few months or try to stimulate, I don't know if it'll work, when GDP falls off an absolute cliff globally.
There's an element of CYA with that, right? Cover your ass, because if their mandate is price stability, even though it probably is largely supply chain driven, the average American voter probably doesn't realize that, right? So I mean, there is, I think, some aspect of they need to appear like they are doing something, even though they really can't fully control it.
Yep. So I don't think they're going to hike anymore. I don't. I mean, that's my personal opinion. And
by the way, if the S&P were to collapse 15-20%, I mean, that would be even further argued for that.
Yeah, and look, my feeling is they are in a box. I'm talking about this for a long time, that they they say they're independent and they say they're free of political influence, but I'm sorry, it's a re-election year. And actually, I'm not sure. I did not see where Powell got reconfirmed. I think he's still not technically reconfirmed. Is that right or wrong?
I think that's right. Yeah.
Yeah. Okay. So I think he's, he probably has to watch his P's and Q's, or he could lose his job. But maybe he wants to lose his job. I don't know. But and what I said is that I don't think it matters, in the sense that I don't believe that the Fed funds at 75 basis points, 1.25, or 25 basis points really has anything to do with where we are. I think where we are is because we printed 50% of all the dollars in the history of our republic in the last 24 months. That's why we are where we are. I don't think it has anything to do with interest rates. Oh, no. And Michael, that's exactly right. Yeah. I don't believe, right, that the Fed are malevolent people and they're trying to figure out. Actually, not true. I do think they're malevolent people, but I don't think they're actually sitting there trying to figure out, well, how do we break the economy by raising rates? I really think they made a mistake. And I think it goes all the way back actually to 2013 when Yellen was still in. I mean, she should have raised then, when we had a little bit of recovery, and then we'd have, bullets left in the gun to lower in the event that we have a recession. And I really think they and everybody else believed that printing all that money following the lockdowns would lead to real economic recovery. And I don't know why they believed that, because the data wasn't there to support that. You had a base effect issue that made it appear like there was a rebound, but now we're back on trend that's negative. I mean, we had a contraction in the first quarter. So I don't know. I don't know any time in history where you have a contracting economy and you raise rates being a good idea. But maybe I'm wrong on that.
Yeah, and Mike, you've been on that with a lot of your research for a while too, right? That this environment is, looks risk off, although I keep going back to the problem, at least in my world, is that the opportunity set for risk off just hasn't worked, right? With Treasury still getting smoked, I mean, with equities when equities are down. How do you think about, and I'll throw this to Mike and then back to Mark, how do you think, Mike, about trying to analyze this cycle when you have so many things just seemingly off sync, right? To go back to Mark's point, okay, so you're going to raise rates, and we may already be in a tech recession. I've made that argument for a while. It's like the problem with this notion that you're not in a recession is that it assumes that inflation is being calculated properly. If inflation is actually higher than what's being reported, then on a real basis, as we've seen, it probably is already negative. And the thing with the NBER is that they only announce it's a recession until long after it's already underway.
Oh, 100%. And that's, when I'm talking about money printing, I was talking about post lockdowns in Q2, Q3 of 2020. And we basically created, at the time, I think it was 39% of all the dollars in the history of the republic. It's 256 years in a period of about 9 months. And then you tack on the last few months, and there has been some money creation. So, we're roughly at half of all the dollars ever created. But you're 100% right that the challenge right now is the average person is not in a strong financial position. They can't go tap into that home equity and take out another loan and make the payment on it, because they just don't have any free cash flow. And the costs of all the things that they spend money on, whether it be food or insurance or, tuition or whatever, is all rising. just I mean, it's a silly little thing, but the parking cost at RDU here in Research Triangle Park is up, 4 on 13. So, it was up 25% in the past 4 months. They've raised it twice. So, and it's not like I park there every day, but I do park there every week. And that's just, real. And if I lived in Chicago, like I used to keep tabs on the parking for the O'Hare deck. And at one point, it was like one day, I did the calculation, one day's parking was 2.5 days after tax of minimum wage. That's just crazy. So I totally agree with you that the money printing rate is falling relative to what it was. And I think it's going to fall even more. And that's why the velocity has rolled over so dramatically here.
Yeah, no, I think that's a good way to phrase it. And Mark, maybe talk about that from the perspective of an advisor, because I've used that line before. It's like they wanted a yield when there was none, and nobody wants yield when there is some.
Right. Look, I think treasuries, as I said earlier, are certificates of confiscation. I think a 10-year or less treasury has no place in anybody's portfolio here. You're far better off
from a buy and hold perspective. I would agree with that, but again, tactic is different. But
but I mean, just in the sense of your whatever return you make is going to be chewed up by inflation, because if rates rise and you replenish the maturities, yes, you'll get a little more yield, but that implies in my mind that you have economic growth and rising inflation, and therefore, it's just going to chew it up. So I just think, it's just a bad trade here. I think maybe you could make a case for the deflation hedge protection of long treasuries here, especially down 24% if you bought them here, only because I think, to the point that someone made earlier, every deflationary period in history is preceded by a spike in inflation, particularly commodity price inflation, particularly oil inflation, which is what we saw. And the subsequent destruction of demand and economic growth leads to an exacerbation of those deflationary pressures. And on top of that, we just have bad demographics and excessive debt, all the killer Ds that I think lead to more deflation than inflation. So, but to me, arbitrage is way more attractive than cash or short duration bonds here.
I am curious, Mark, if maybe you're outwardly or maybe subconsciously getting nervous about some kind of a sovereign debt crisis that could be looming. And I say that because the dollar's strength, I think, has been perplexing. And I've kept on alluding to this idea that the dollar is acting as if there's a sovereign debt crisis somewhere out there. And a lot of people argue, well, this is expected because of interest rate differentials. I don't buy that, because the dollar started rallying, first, second quarter of last year. It's been going kind of vertical more recently, right? But talk through if you think there might be some risk that nobody sees coming, right? Which is what the definition of black swan is, given this kind of setup of what looks like a global margin call, that something could just come out of nowhere that nobody sees coming, that could be far worse than anybody imagines.
Yeah, look, I agree. But again, I argue, and I know people will argue with me, and Professor Plum will really argue with me on this. Or actually, not so much as Santiago would argue with me on this. I said I don't think the dollar's strong at all. I just think it's less crappy than particularly the yen. I mean, the yen has gone from 110 to 130 in 6-7 weeks. I mean, that's insane, especially insane because historically, when markets go risk off, because Japan had such low interest rates, it was a funding source for lots of global carry trade. The yen had historically strengthened in these periods. It's done exactly the opposite. So to your point about, is there a sovereign debt crisis? There might one in Japan. I remember being in Japan 10 years ago, meeting with the CIO of the largest pension fund, and he had 90% of his portfolio in JGBs. And JGB rates at the time were like 1.5. And I'm like, it seems like a pretty risky trade. He says, I am perfectly comfortable with my portfolio. And it turned out he was right for the next 9.5 years. Last 6 months, not so much. So I don't know. I think there is. I'll go back to my primary premise is the central banks are going to continue to do QE forever until such time as there are debt jubilees. I think the first debt jubilee will be in Japan. They're at 76 or 78% of all the JGBs are owned by the Bank of Japan. And when they get to 90 something, whatever it's 3, 4, 5, they will declare them, net neutral, and they'll start over, just like the UK did in 1863 or 4, whenever it was. And then Europe will be next, and then the US will follow. And so this idea that the Fed's going to shrink their balance sheet, I call bullshit. The idea that Lagarde's going to stop printing money, I call bullshit. The idea that, crazy Kuroda-san isn't going to, actually he's got to bid out, right, for every bond for yield curve control. The problem is it's at the expense of his currency, but he wants, see, this is the thing, he wants his currency to be destroyed. And the euro will then follow. Euro's coming up on parity here, right? And I think it will continue to crash. And then the dollar looks like it's strengthening, but then you compare it to things like the renminbi and the ruble, it's actually not. And so this alliance between China's Belt and Road Initiative, which runs from China all the way through India, up through the Silk Road routes into Russia, and eventually into parts of the Nordics, I think there's a massive dual axis forming, and everyone says, "Oh, we're in World War III." I've heard a lot of people talk about there. And yeah, we are, but the war isn't fought with ships anymore. It's fought with chips, and it's cyber warfare, and central bank digital currency warfare. Right? There's a reason that China has a central bank digital currency first, because their goal is to have the world reserve currency. Right now, they have a world reserve currency. They want to have the world reserve currency, and the only way to do that is to get people transacting in renminbi instead of dollars. The petrodollar system is over. Not tomorrow, but it's over. And it peaked 12 months ago, 18 months ago, whenever it was. And there's going to be this subtle chipping away of that hegemony over the next, 10, 15 years. And I think we'll look back and like, how did that happen? How did we lose world reserve currency status? I don't know, because the other team had a plan and we got crappy leaders.
So do a thought experiment with me on this, Mark, because this is now going a little bit into the realm of Bitcoin being a solution. And I've said many times that I don't believe Bitcoin is the solution. I believe law and a rules-based central bank is the solution, right? Because the problem is not fiat. It's the removal of stimulus when you have, in a democracy in particular, incentive to constantly promise more, which means take on more debt. And fiat can be perfectly fine if you have some kind of limitation and mechanism to pull it back on a mechanical basis, I would argue. And I see Dr. Al-Haji is here. I did a space with him, and we were talking about Bitcoin for a moment. And we were talking about the idea that Bitcoin can't possibly be a reserve currency unless it's big enough to be the currency of choice for, right? Because oil is ultimately what determines the reserve currency and how that's priced. Talk through how you think about the interaction for a moment of rules-based central banks, cryptocurrency as a solution, and how that interacts with oil. I know this is kind of a big question or big.
No. Look, it's easy. Bitcoin is digital gold. Gold is money. It's the only money in the world, right? Money is an asset that exists in the absence of a liability. Everything else is currency and credit. Every currency in the world is backed by debt. And fiat, to your point, is controlled by politicians. And those politicians are profligate spenders and hoarders for their cronies. And that's why there have been 775 paper currencies in the history of the world. 3/4 of them no longer exist. The oldest, the pound sterling, has been around for 376 years or whatever. And £1 note used to get you a pound of sterling silver, and now take you 174 pounds of silver. So that devaluation is the nature of the beast. And there is no rule system that will be followed that will preserve any fiat currency. All fiat currencies will eventually go to zero. And that's why gold, for 5,000 years, 1 ounce, has bought a fine person's suits, perfect store of value. And now, but it has two fundamental flaws. It's very heavy and it's not very divisible. Bitcoin, because its stock to flow ratio is the same as gold and it is in code and it can't be changed, it will become the digital version for the next 5,000 years of that perfect store of value, and it will be money. So let's think about this. Does gold exist in the same world as fiat currencies? Yes. Will fiat currencies disappear? I don't think so. Although, if you had Murray Stahl come on the space, he would make a very elegant case why the reverse of Gresham's law will eventually occur and the Bitcoin will subsume all money in the world over the next, pick a time period. And I'll let him make that case. For now, I believe that Bitcoin will become a reserve currency, just like gold is a reserve currency. And think about why we have the system we have. We have the system we have because in 1973, we cut a deal with Saudi Arabia and we said, we will protect you no matter what you do. We will protect you as long as you price all oil transactions in dollars. Anyone who threatened that, right? Iraq threatened that, and we got rid of their leader. Gaddafi in Libya threatened that, get rid of him, because he was going to price in gold, and Iraq was going to price in euro. Problem is, when Russia and China threaten to price transactions in rubles or renminbi, we can't get rid of them because they have nuclear weapons. So that movement away from dollars and the petrodollar system to the renminbi will continue. I think the renminbi is more likely to be the next world reserve currency. And ultimately then Bitcoin, as it continues to take share from gold and become money and become a monetary base. And I'm more excited actually about the payment rail system that is the Bitcoin blockchain, which will replace the Fedwire system and ACH and Visa and MasterCard as we build layer 2 and layer 3. But I probably didn't even answer your question, but
it sounded really good, and I'm just and that's the key to all this. And I will say that I still think that lentils are a better store of value than gold and maybe Bitcoin, but that's just my biased opinion. So, listen, everybody that's joined for the hour, please make sure you follow Mark Yusko. Hopefully, follow me too as I do these spaces pretty much every day. Mark, I appreciate you spending this Friday afternoon, evening, depending on where you are in the world, and everybody enjoy the rest of your day.